Hi guys, and welcome to another tutoring video. Today we're going to be going over part 2 of insurance basics. Okay, so insurance basics is quite a large chapter, has a lot of information in it. Today we are going to be going over underwriting, what is a field underwriter, what goes into the application process, and how does the application actually get approved or denied. So we're going to be going over a lot of information. Let me go ahead and share my screen. There we go. Perfect. All righty. So underwriting, right? Underwriting is the risk selection process, okay? An underwriter's responsibilities include selecting only those risks that are considered insurable and can meet the insurer's underwriting standards, okay? The purpose of underwriting is to protect the insurance company against adverse selection. So we hear about this over and over. Adverse selection is basically negative selection, right? It's the risk of too many poor risks being accepted compared to the intermediate risks and preferred risks, right? So too many unhealthy people, too many older people, and not enough of everyone in the middle. Okay, so to protect against this, the insurance company has underwriters that do their research and look into these people before they issue the policy. Okay, all right. So underwriters work for the insurance company and they're looking for specific information. The first place that they're going to look is at that application. But past that, the underwriters are the ones that do all of the digging and look into us when our application is taken in. Okay. Now there's field underwriters as well. Field underwriters are the agents. So as a field underwriter, our job is to make sure that we're soliciting to the right kind of people, right? That we pick our market well, that we help prevent adverse selection by choosing good people to solicit to, completing that application, taking in any payments, issuing receipts, and of course, delivering this policy to the client themselves. So the field underwriter has a special job in the underwriting process because we see things that the regular underwriters can't see, right? The underwriters for the insurance company can only look at the information on their computers. They can't see this person. They can't judge if they're lying or, being truthful. And they're not in the home with this client. Okay, so that's a special power that us as agents have. So that's what a field underwriter is. Now we're going to be going over the application and kind of the process in issuing the policy today. So the application is the first and foremost starting point, right? The basic source of information used by the company in this risk selection process. So in the underwriting process, the first place they're going to go is to that application. Okay. Although applications are not the same for every company, they all have basic information that's required, and every company still needs like the same type of information. So there are two parts to the application. The first part is general information, and it's exactly what it sounds like. It's name, address, right, age, occupation, what's your gender at birth, all of that. So all the basic general information is done in part 1. And these we need to know in the test. So it's just good to know it. Part 2 is the medical information. Now, for the medical information, it's going to include several things. So first is obviously our medical background, right? They need to know how our background is medically. Next is our present health, how we're doing right now, right? Any medical visits, any time spent in the hospital. It's also going to ask the health situation with our living relatives. So usually mom or dad. They usually ask, have your parents passed away before a certain age, right? Are your parents still with us or deceased? So those kinds of questions fall under the medical background and not the general information. Okay. So, the health, right, of relatives, right, the causes of death of deceased relatives, usually it's just mom and dad, but that all falls under the medical portion, okay? And then there are medical applications and there are non-medical applications. So non-medical applications means that there is no blood work that's needed, right? If it's less than 300,000, normally the company allows you to just do the application and they're going to base their opinion off of the information that you give them and off of your background. Now, for a medical application, this is for people who want more than 300,000 in insurance benefit. Okay, so if they want $500,000 of insurance benefit, right, they're going to have to give blood and do some kind of physical examination by a professional. Here with our company, they send them to your home and it's a very easy process, right? But all of that falls under the medical portion, okay? So it is the agent's responsibility to make sure that the application is actually filled out to the best of their ability, of the client's ability, trying to kind of feel out any questions or maybe not understood, right? If there's any sections that are not understood or the questions, get back an answer that seems like there's more to it, we need to kind of help that along, right? So we just make sure that the application is complete, that it's as honest as possible, and that everything, every signature is dotted, everything is done before we send it over to the insurance company, okay, for review. Now, if an application is taken at the time of purchase of a policy, meaning they pay upfront for their policy, the application must be attached to the policy. Now, this we just need to know for our test. It's not really in real life. Nowadays, everything's kind of electronic. But just know that if a payment is taken at the time of application, a copy of this application must be attached to the policy. Okay? That's all that we really need to know for that. And an agent's report. So an agent's report is important for the insurance company to get vital information from the field underwriter. So field underwriters, like I said, we see these people face to face. Let's just say we sat down with a client and this person said, no, I'm not a smoker, right? But they smell like smoke and their house smells like smoke and there's cigarettes on the coffee table and they're obviously smokers, right? We can't really, as agents, be like, are you sure about that? Are you sure about that? We can't really do that. We can do our best to kind of press a little bit. But what we can do is use the agent's report to send vital information over to the insurance company. That way they have the same information that we have and they can take that into consideration when they're looking at approving or denying this client. Now, for the agent's report, right, the insurance or the insured person, right, the applicant, they will not see these notes. Okay, they do not become part of the policy. Okay, it's just information. It's an exchange of information between the field underwriter and the insurance company. Okay, so like I said, that's good. That's something we need to know for our test. The agent's report does not become a part of the entire contract, although it is part of the application process no one will know the difference. Okay, so we can let the insurance company know any information without kind of putting our foot in our mouth. Now, required signatures, okay? All of this is just very kind of basic information when it comes to the application for the policy. But if these things aren't done correctly, the application will be not taken, basically, right? It's going to be kicked back. So both the agent and the proposed insured, meaning the person who's applying, right, must sign the application. Must sign the application. Even if this person is not the applicant, they need to sign the application because it's on them, unless they're a minor. Okay, so if the proposed insured and the policy owner are not the same person, such as a business purchasing life insurance on an employee, then the policy owner must also sign the application. So basically, let's just say the applicant is the insured person. Their signature and the agent's signature needs to be on the policy. Let's just say that there's a policy owner, there's an insured person, and the agent. All three need to have their signatures on the policy. Think of a husband and a wife, right? The agent is sitting down with the husband and wife, and the husband is intending to pay for this and is applying, but it's on the wife's life. We need to have all three of those parties' signatures. So anybody's name who is on this application, whether it's the policy owner or the insured person, unless they are a minor, need to be signing this contract, okay, this policy. So the reason why it's so important to get a signature as well is because the applicant's signature attests to the accuracy of the information in this application. With them signing, they're saying, yes, this is my application. Yes, I am aware of this policy being drawn up, and all of the information is to the best of my ability, and we sign it off. So that way we are attesting to that information. I talked about this last time, but any changes on the application have to be done in a certain way, okay? When an answer to a question on the application needs to be corrected, agents have the option, depending on which insurer they represent, right? The company usually dictates which one they would like done, of correcting the information and having the applicant initial the change, or completing a whole new application, okay? This you probably will see a small question about on your tests. So which of the following is an inappropriate way to correct information? It's going to give you those two options, and erasing, that's a no. White out, that's a no. We can only correct information with those two ways. Start a whole new application, or correct the information and have the applicant signature or initial the change. Okay, so only two ways. Now, what happens if the application is left incomplete? It's sent in incomplete. So before a policy is issued, all of the questions on this application must be answered, right? If the insurance company receives an incomplete application, the insurance company must return it to the applicant for completion. They're going to kick it back to the agent or the RVP. They're going to say, hey, signatures on this, this, and this are required, and they're not there. These questions, this, and this, are not answered, and they're not there. Can we get answers on this? However, if the policy is issued without getting answers to these questions, right? Without these answers being on the policy application, okay? So if a policy is issued with questions left unanswered, the contract will be interpreted as if the insurer waived its right to have the answer to this question. This will be on your test in probably one question, okay? So if it is not filled out to the best of its ability, the first option that they are going to take is sending it back to the agent to get it completed. But if the insurance company processes that policy, right? They say, yes, you're good, and they take the premium. Then any unanswered questions are then considered to be forfeited, right? Let's just say the smoking question wasn't answered, whether they do or don't smoke. If they accept this policy and process it, and we get a policy in hand, but they didn't get that question, they are forfeiting their right to knowing that question. Okay? So just know that if there are unanswered questions, they're going to send it back. But if they don't and they process it, they will take the application how it is. And those questions are then forfeited, meaning the insurance company has forfeited their right to know the answers to that, okay? When it comes to premiums with the application, most agents, right, are going to collect the premium at the time of application, the first month's premium, right? And submit it along with the application. That way everything kind of goes smoothly. There are really only a few instances where you won't do that, and that's if the money is not readily available right there. Or it's something called COD, cash on demand, right? If someone has health issues and we don't know if they're going to be accepted or denied, sometimes we'll take a deposit, or we won't take a deposit. We'll do the application. We wait to see if they're approved, and then we go back and take that deposit. But it's just kind of double the work. So normally the agents attempt to collect the initial premium and submit it along with the application. Okay. Now, when we collect the premium at the time of application, we need to give them a premium receipt, right? We need to give them some kind of receipt telling them, yes, you have prepaid for it. So when a client prepays for their policy, they have what's called conditional coverage. Okay. What it means is, while we are waiting to hear whether they are or are not covered, right? Whether they're accepted or denied, in this middle area, they are conditionally covered for that period of time. If someone were to pass away during this period of time where they haven't been accepted, but they haven't been rejected, and they would have been accepted, meaning they had good health, there was no reason for the insurance company to deny them, they will still be paid out even though they technically were still in that waiting period. Okay, that's called conditional coverage. So conditional receipts, these ones are the most common type of receipt when it comes to insurance. This is used only when the applicant submits a prepaid application. Okay. The conditional receipt says that the coverage will be effective either on the date of the application or the date of the medical exam, meaning the blood work. Okay, it's either or. If they require blood work, it's going to start once the blood work is completed. If they don't require blood work, right, it'll start on the day of application and payment. Okay, you might get a question about that on your test. So conditional receipts, right, these are very important because it's going to tell the insurance company when this conditional coverage starts so that there's no questions, there's no gray area on who should be covered and who should not. Okay, so the conditional receipt marks when this conditional coverage begins. Okay, so like I said, this is going to be only if this person was going to be accepted. If they were going to be denied, because of health, because of some other issue, then this conditional coverage is void. Okay. This is only on the condition that they would have been accepted. And then you have binding receipts. So binding receipts are not normally used when it comes to life insurance. They're used more for property insurance. Okay. So binding receipts are more like a guaranteed coverage instead of conditional coverage. Like think about your house. You applied for home insurance, right? Like fire protection, right? And they were taking forever. So you apply, you pay your first premium, and they're taking forever to accept you. During this period where you're neither accepted or denied, your house could get damaged. And let's just say it does. A binding receipt is almost like a baby policy of its own. While we're waiting to hear whether we are approved or denied, a binding receipt gives guaranteed coverage while we wait. Okay? This is kind of why it's not used very often, and it's definitely not used when it comes to life insurance, because it's a guaranteed baby policy, basically, that promises coverage while you wait. So, like I said, a binding receipt or unconditional receipt is rarely used in life insurance. Binders are more commonly found in property insurance. When the agent issues a binding receipt, coverage begins immediately for a specific length of time, even if the applicant is later found to be uninsurable. Binding receipts usually stipulate that coverage is effective from the date of application for only a specified period of time, such as like 60 days. Okay. Or until the company either issues or declines coverage. So a binding receipt is like its own little policy. Okay. So written binders are deemed to be valid insurance policies for the purpose of providing that the insured has coverage. So let's just say you purchased a brand new house. Like I said, sometimes they require that you buy homeowners insurance, like in order to get the house. Like they want to make sure that that's all in place. A binder would be able to fill that need, at least for the time being. Okay. All right. So when it comes to the application, like I said, there are non-medical applications and there are medical applications. Okay. So we already kind of went over that. Just know that medical applications are requiring some kind of physical, usually whole life, universal life, some types of term, depending on how old you are, how much coverage you need, requires blood work or a physical. That's a medical exam. Non-medical exams is for lesser coverage, usually below 300,000. And that is when they are going to approve or deny you based on your application and your background. Okay. Perfect. All right. Now, with the underwriters, they are going to place us in three tiers, right? Three sections of people. There are standard risks. There are substandard risks, which means like a sub is lower, right? So substandard risks and uninsurable people. There's also preferred risks. So I'm going to go over those really quickly. So first one we'll go is the highest. Preferred people are going to be your very healthy people. They are the ones that get a lower discounted rate based off of their age, based off of their health, their weight, their health overall. Okay. I always joke because my sister is like this big and she's a vegan. She runs. She's like a hippie. She is preferred. She's like the most preferred person. She's very healthy. Okay. So we have our vegans and our runners, those are the preferred people. Six-pack people, those are preferred, okay? Then we have standard individuals. I am what's considered standard, okay? I might be, actually, I think I'm preferred, but it's fine. Standard are like your people that are normal height and weight, right? They're not obese, but they're definitely not like vegans. You know, we don't run for fun, right? So standard people is the standard population. These are people that are healthy. They're not unhealthy, but they're definitely not like super healthy. They're the middle population. And then you have substandard. Substandard people are people who are a higher risk to insure because of, maybe age, weight, medical history, prescription history, and something along those lines. Those are called substandard or below standard people, below standard risks, not people. And then you have uninsurable people. So for instance, people who might have cancer, might have diabetes, might have, I don't know, heart issues, different kinds of things. There's a lot of reasons why people could be uninsurable, but uninsurable means there's no way that they would be insured with pretty much any company. Okay. Perfect. All right. So we're going to be going over how the underwriters get all of our information. Okay. How do they know all of this stuff? And there's a lot of different ways that they can look into us. Okay. So the first one, like I said, first and foremost, they are going to be using that application. That is going to be the basic source of information for the underwriters and for the company. Second, we have the agent's report. They are going to go to our notes, go to our statements, and see how this person's overall health was. The next thing that they're going to do is called an investigative consumer report or inspection. Okay. So to supplement the information on the application, an underwriter may order an inspection report on the applicant from an independent investigating company, okay, firm or credit agency. This is going to cover all financial and moral information, meaning our finances and our background, okay? They are general reports of applicant finances, character, work, hobby, and habits. But with an investigative consumer report, they can look into what they can find online, right? They can do all of that. That's the consumer report, sorry. Consumer reports, they can only look at what they can find online or in our history, okay? The next step, if they really wanted to, they can request an investigative consumer report. Investigative consumer reports are similar to consumer reports, but in these, they're going to get the same information, the character, reputation, history, finances, all of that. But with the investigative consumer reports, they are actually able to get written verbal statements from our family, from our friends, from our coworkers. They're able to get way deeper and get personal information for the reports. Can you for the reports. So consumer reports is anything that they can run in the system. Okay, whatever they can find on us. Investigative consumer reports is when they start calling our family, they ask for references. I've had that happen, I think, to one client before, but that's if they really need to dig deeper on us, okay? Now, with these investigative consumer reports, because they are so much more in depth, there's some requirements for the person that's going to run it. So for the investigative consumer reports, these right here, unlike consumer reports, these reports cannot be made unless the consumer is advised in writing of the report 3 days of the date the report was requested. Okay, so once these people request this report, they need to notify the client within 3 days. Okay, they will notify them in writing. Okay. The consumers must be advised that they have the right to request additional information concerning this report, and the insurer or reporting agency has 5 days to provide this additional information. So those 2 dates here in California, we kind of need to know because they like to throw those questions in there randomly. So we need to be notified that an investigative report is happening 3 days, right? Within 3 days of the date the report was requested. If we request additional information or a copy of this report, it must be given to us within 5 days of that request. Okay, so 3 and 5. Now, not anybody can just run these investigative reports either. Okay, let me get to the part. There we go. Okay, the reporting agency and users of this information are subject to civil action for failure to comply with the provisions of the Fair Credit Reporting Act. Okay, this is basically a law that protects people against their information just being run for no reason. Okay. A person who knowingly and willfully obtains information on a consumer from a consumer reporting agency under false pretenses may also be fined and or imprisoned up to 2 years. What that means is not anybody can just be running these reports for no reason. You can't be like, hey, I wonder what my ex-girlfriend's up to, and like run her report. They're very sensitive, so you have to have a reason for doing it. Not anybody can just run your report, okay? There are laws when it comes to the Fair Credit Reporting Act, and to go through it is honestly painstaking. It's boring. This is where we need to go through and take the quizzes. That way we get familiar with the California laws or whatever state that you're in, because every state has different information. So you need to make sure that you're quizzing and that you're reading up on your own states and laws. Okay? All right. Perfect. Okay. So the next area that could be used, right, is going to be the medical report. So let me get right back up here. There we go. Medical information. Okay. So let's just say that they did request that we get blood work done or a physician's workup, right? A physical. They are able to go to those reports and see how our health is. Okay. That's pretty self-explanatory. They can also contact the MIB. In California, we need to know who the MIB is. The Medical Information Bureau, not Men in Black, is basically a big, huge database with everybody's health information between companies. Okay. So in addition to an attending physician's report, the underwriter will usually request an MIB report. It's basically a quick scan on all of our medical history and any applications that we may be putting out to other companies. If they happen to see that we've been declined or denied by a lot of different companies, that's going to raise some eyebrows for them and they're going to do more digging. Okay. So the MIB, and this we need to know for our test, is a member corporation. Okay, it's only owned and operated by members of the MIB, meaning different insurance companies, different health companies, okay? So the MIB is a membership corporation owned by the member insurance companies. It is a non-profit trade organization for the purpose that is to collect, maintain, and make available to insurance companies important underwriting information on applicants when it comes to life and health insurance. Okay. It is a systematic method for insurance companies to share and compare information on the people who are applying. Okay. Now, the MIB is able to assist in information, but we are not, the insurance company is not allowed to deny us simply because the MIB gave adverse information. Okay, so it needs to be backed up with something in our physician's report, in our application. It has to have secondary information with it. So an applicant cannot be refused simply because of some adverse information discovered by the MIB. Okay. Now, when it comes to HIV testing, okay, every state is different. So here in California, everyone gets tested. It's part of the blood work, right? If they run blood work on you, they're testing you for HIV. And they do not need to tell your physician about it. They don't need to tell any other agencies about it, but you can be denied because of it. So because it's different in all of the different states, you shouldn't get too many questions on HIV, right? Testing. Just know that it needs to be given to everybody if they're going to give it, right? And then also, they cannot discriminate when it comes to HIV testing. Okay, it can't be based off of zip code. It can't be based off of sexual orientation. It can't be based off of, I don't know. Let's just say we all live in North Hollywood. They can't just HIV test everybody there and not anywhere else. Okay, it needs to be clean across the board, and it needs to be something that they test on all their applicants if they are going to blood test them. Okay. All right, meaning they can't discriminate in testing for HIV. That was what I was trying to say. All right. So HIPAA. What is HIPAA? The Health Insurance Portability and Accountability Act, or HIPAA, right, is a federal law that protects health information. Okay. This has specific regulations that are provided or that provide protection for the privacy of certain individually identifiable health information, such as demographics, whether it's our physical health or mental health, any kind of diagnosis, medication that we take, all of that is protected by HIPAA. Okay, that's in every state. But the fines and the repercussions of not abiding by HIPAA is different for every state as well. So make sure that you go through your state laws. Okay. When we are testing, when we are quizzing, this stuff will start to make sense to you. It's just too much to go over when you're doing tutoring. This is why it's important to take those practice tests and study our incorrect answers, guys. Okay. All right. When it comes to disclosure of insurance information, okay? So when insurers plan to seek and use information from these investigators, whether it's from our underwriters or consumer reports, any of that, they must first provide the applicant with a written disclosure authorization notice. Now, the best example I can give you about that would be when we get our blood taken. Right? When they do the paramedical doing their blood and they test us for all kinds of different things. They give us a disclosure saying what these tests will be, why we are having them, and what are required by the company. So that's a disclosure letting us know what is going to be tested and what they're going to do with that information. Okay. Perfect. We already went over risks, so we are all good there. There we go. All right. Next, right? So first was solicitation and presentation, right? Next was underwriting. Now we have premium determination, okay? Now, for premium determination, I'm just going to pick out little things that we need to know about them because this is a lot of information that doesn't necessarily have too much to do with our test. We just need to know certain things, almost like keywords, right? Or terms to know. So first things first, once the company determines that the applicant is insurable, they need to establish an appropriate policy premium, right? Based off of age, based off of work, health history, and our sex, whether we're male or female. They are going to use all of those things to come up with a premium, and then this needs to be paid in advance. So insurance runs like this: payment, coverage, payment, coverage, not coverage, payment, coverage, payment, right? Let's think of a phone bill. You use your phone for that month and then you make a payment for the next month or at the end of the month, right? Insurance, life insurance doesn't work that way. You pay your premium and then you're covered for the month that you paid for. You pay your premium, you're covered for the month that you're paid for. Okay, so just know premiums are always paid in advance. Okay. Now, when it comes to the insurance business, right? It is a business. It's a huge business and it runs off of statistics. Okay. So they use something called mortality tables. Now, the word mortality, right, is the ratio of number of deaths in a specific population over a certain amount of time versus the number of people living in that population. I know that sounds confusing, but basically they take a group of people, right, all with the same exposure, and they see how many people pass away in that group, and they make a statistic off of it. After looking at these groups of people for long enough, they're able to come down to a pretty minute or a pretty fine idea of how many deaths are going to happen within that group. Like after a while, it's going to average out. They've been doing this for a long time. Okay. So they have pretty good information, pretty good know-how on how many people within a certain group are going to pass away. Okay. So mortality tables are used by insurance to indicate the number of individuals within this group, males, females, smokers, non-smokers, 30-year-olds, 36-year-olds, 70-year-olds, right? Different things like that, starting at a certain age, who are expected to be alive at that succeeding age, okay? In other words, these tables help the insurers predict the expectation of life and probability of death for a given group, okay? So this just allows them to kind of know how many policies they may have to pay out within a given group. Okay. Perfect. All right. Now, with this premium as well, there's something called expense charges. Okay. Expense charges. So the expense factor is also known as a loading charge. Okay. This affects the premium rates. Insurers have various operating expenses. Think about all the people that work at home office, the processing of payments, the paperwork, people who actually type up the policy. There's a lot that goes into creating this policy and issuing this policy, okay? So what they do is they spread this expense rate into everybody who's paying premiums in order to pay those individuals to keep the business kind of going, right? All those expenses that need to get paid, that go into the making of the policy, are then distributed out within those premiums. Now, there is something called a premium payment mode, okay? All this means is the mode of payment. How often are we going to be paying this premium? What is the frequency? Okay. And there's four options. There's a monthly, which most people do. There's quarterly, right? 4 times a year. There's semi-annually, which is twice a year. And then there's annually. You could pay your insurance premium once a year if you wanted to. I've had clients do that. So just keep in mind with the premium payment mode, we need to know that the higher the frequency, right, the higher the premium. What this means is, remember that there's that expense charge and there's interest and there's just the insurance cost itself, right? The more times you process a payment, the more expensive your premium is going to be. So monthly is actually the most expensive frequency to pay your premium on, because every month there's an expense charge and a loading charge. Annually is the least expensive way to pay your premium because you're only paying one expense charge as opposed to 12. Okay, so annually is the cheapest way to pay your premiums. Monthly is more convenient, but it's the more expensive option to pay your premiums. Okay. All right. Now we have ways to pay our premiums, okay? There are several different ways to pay our premium when it comes to insurance. Most of these we're not really going to see. 90% of the time, it's either single premium or fixed versus flexible, okay? So these, I'm going to fly through them because when we talk about types of policies, that's where we're really going to get into the types of premiums, which ones they belong to, okay? So the first option when it comes to premium is going to be single premium, okay? This is when the policy owner makes one lump sum premium to create a policy. Okay, this is not very often used because if you really think about it, who has all of that money just sitting there? Not very many people, right? Let's just say I want to buy a 30-year term policy. That's a lot of money. That's thousands upon thousands upon thousands upon thousands of dollars, right? So very few people pay single premium policies. Okay. When it comes to annuities, they might, but for life insurance, probably not. So single premium just means that the policy pays one single lump sum premium to the insurance company to create this policy. Okay. Limited pay, a level annual premium, right? This is what limited pay is. This policy is designed so that premiums for this coverage will be completely paid up before age 100. We are going to talk about limited pay later on, so I'm not going to get too far into it. Like I said, limited pay premiums are designed so that you pay a level premium every month, and at some point, right, your premiums will stop, okay? Usually before age 100, because when people get older, they don't want to have to worry about paying this premium for their whole life, okay? But we will talk about more of that later. Limited pay means we only pay for a limited amount of time. Modified pay. A lower premium is charged in the beginning years of the policy, okay? These are normally for whole life. Limited pay, modified pay is for whole life, and fixed and flexible. Modified pay, a lower premium is charged in the beginning years of the policy when this person is young, when they are still building their estate and getting their finances in order. Usually 5 to 10 years later on down the years, or right here, usually the first 3 to 5 years, they will pay this lower benefit or this lower premium, okay? Then after that 3 to 5 years, it is going to shoot up and level out at a higher premium for the duration of the policy, okay? So modified pay, it's less expensive the first 3 to 5 years. After that 3 to 5 years is up, it shoots up and it levels out at a higher rate for the rest of the duration of the policy. Okay. These policies were developed to make the purchase of whole life insurance more attractive for individuals who, for example, are just starting out and have limited financial resources. We will get into that more as well. Next, we have level. So level, we want to think about term, right? That's like the easiest way to think about it. Level is most life insurance policies' rate of premium, okay? Level means that the premium remains the same throughout the whole duration of the policy, okay? It never goes up and it never goes down. That's a level premium. And then fixed and flexible. With a fixed premium, the same amount is paid, but periodically. Okay, like you could pay that amount and then decide, you know what, next month I can't do it. And then you can kind of do that, right? But it's always the same fixed amount. It can change in frequency, right? You can pay it here, you can pay it there, but it's always going to be fixed. Flexible, right, is kind of like that, but this is when the policy owner is allowed to pay more or less than the planned premium. Okay. Don't get too overwhelmed with understanding those yet. When we go over types of policies, it'll make more sense, but we definitely do need to know what those are for our test. Okay. Perfect. And then lastly, we have policy issue and delivery. Okay. With policy issue and delivery, this means that the insurance company has gone through the underwriting process and has decided to approve us for this insurance. Okay. Now, once the underwriting process has been completed, the agent is in charge of delivering this policy. Okay. Although personal delivery of the insurance policy is the best method for finalizing this insurance transaction, mailing the policy directly to the policy owner is acceptable, but only if it's done in a certain way. Okay. And this we need to know for our test. When the insurer relinquishes control of the policy by mailing it to the policy owner, the policy is considered legally delivered. However, it is advisable to obtain a delivery receipt. Okay. So these are going to be the methods for delivery. The first one is obviously going to be personal delivery. Okay. Because when we do that, there's a page inside of the policy that's a delivery receipt. The client signs off on it. We turn it into the company and it kind of solidifies that we did our job, that we delivered it in hand to the client, and they can't say that we didn't. Second, we are able to send it with registered or certified mail. Registered and certified mail, those are the two types of mail delivery that needs a signature. Someone needs to sign off on it in order for it to be dropped off. So that is going to in turn take the place of that delivery receipt. First class mail with a signed and dated written receipt of delivery is also allowed, but you need to make sure that it's signed and delivered. Now, I think there's a question on your test, and I can't remember what exactly the option is that they set it. It'll say, which of the following delivery methods is not acceptable, right? And it says first class mail, it says a certified mail, personal delivery, or something else type of mail, like overnight, right? Overnight mail or something like that. If it doesn't require a signature, it's not acceptable technically. Okay, we need to make sure that we get a signed delivery receipt, because without written and signed proof of delivery, the burden of proof of delivery falls on the insurer and its agent in any legal dispute. So let's just say something happens, someone passes away and they don't have their policy, like something happens, that's going to fall on us because we don't have proof that it was actually delivered. Okay. All right. Now, advantages to personal delivery. There's a question on your test that says, which of the following is not considered an advantage of personal delivery? And it says, thoroughly explaining the policy and answering any questions when it comes to riders and da 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 da, right? That it says to catch up with the family, right? Yes, catching up with the family is a good thing, right? It builds rapport, it builds connection and relationship between your clients, but it is not required. Okay, so when you see that question, or if you see that question on your test, it's like I sat there and I looked at my test and I was like, technically, like that's an advantage, but that was the incorrect, or that was the correct answer, saying that that was not necessary. So the advantages is giving yourself another opportunity to explain to the policy owner what they've purchased so that they understand and are less likely to cancel their policy. It reinforces personal relationship with the agent and the company that the agent represents. It gives the agent an opportunity to assess future needs, such as investments, mutual funds, all of that. And then if the paperwork or information gathered in underwriting was incomplete or contradictory, the insurer may require the agent to revisit the client when delivering the policy and also get signed confirmation. Okay. Perfect. All right. So as an agent, it's also our job to make sure that the client understands the policy that they've been given. Okay. Personal delivery of the policy allows the agent the opportunity to make sure that the insured understands all aspects of this contract, especially if there's any changes to the contract. So like I said, when we sit with a client, we give them illustrations, right? We give them non-guaranteed figures. Well, what happens if they get rated, right? They have to pay a higher premium because of their health, because of their weight, because of their age, right? So when we meet with them in person, it's important to go over all of the provisions, all of the riders, and make sure that they understand the contract that they've purchased, okay? An agent should be explaining the rating procedure to the client, especially if the policy is rated differently than applied for or has been modified or amended in another way. Okay. The agent should also explain any other choices or provisions available to the policy owner that may become active at this time. So just making sure that they understand. Okay. The title page, the policy title page, right? That front page that comes like on the front of the policy. This is the first page of the life insurance policy. This page contains a summary of all of the benefits and coverages the policy will provide. In addition, the following information is provided on this title page. So the type of policy issued, just like I talked about the policy summary earlier, it's going to have the same. The premium payment method, what type of insurance, generic name for the insurance it is, what their beneficiaries are, is actually going to be found on a different page. Okay. So the policy summary is not going to state the beneficiaries, and that might be something that they ask on your test. There is a beneficiary page that gives that information on its own. Okay. Perfect. All right. Let's just say that the insured or now insured person, right, the applicant did not pay at the time of application. If the initial premium was not paid with the application, the agent is required to collect that premium at the time of policy delivery. So like I said, with COD, these people, we're waiting to see if they've been accepted or denied before we take that payment. So what happens is the insurance company runs the background and then lets us know whether they've been accepted or denied. Once they've been accepted, we go back to the client and we collect that premium, explaining all of the parts of the policy there. When we do this, the agency may require the agent to get something called a statement of good health. What this is saying is, hey, since the time of application, have you been in the hospital? Have you been diagnosed with anything? Has there been any kind of change to your health history, right? So getting that statement of good health may be necessary, and it must be signed by the insured that verifies that the insured has not suffered any injury or illness since the application date. Okay, so statement of good health is important.
Oh, please, over there. Over there. Oh, I want you to look like.
Perfect. Alrighty. So I think this is a good place to stop here. Next, we're going to be going over life settlements, and we're going to be going over types of policies which go hand in hand. I hope you guys are all making your way through your hours and taking your quizzes diligently. If you have any questions, reach out to your RVP or the person that helped you, and let's get you licensed. We need to be making progress every single day. And as I said in the last video, I hope that while we're watching these tutoring videos, we're also running our hours at the same time. That way, we're still getting hours, points, minutes being watched while we're doing the tutoring videos. Because as great as the tutoring videos are, those required hours are still going to be necessary before you can take your exam. So we want to make sure that our requirements are done. That way, when we understand and we're ready to take the exam, right, there's nothing stopping us and we're not trying to cram all of these hours in multiple days. So make sure that we're being steady with our stuff. Every time we do a tutoring video, we should be quizzing afterward multiple times. For our team, we say 10 quizzes a day, right? That's like minimum, 10 quizzes a day. They're 12 questions long. Anybody can do 12 quizzes a day. I hope you guys have a great day. See you later.